So let's get things kicked off with an easy one. Tell us what the main problem is that USDAI is aiming to solve and how it has turned into a tangible reality for you because it hasn't even launched yet. You're not in mainnet. It's still very much in beta, but you're turning this thing into a reality.
Yeah, so let me give you a little history on what we've been building as a company over the last few years and kind of, how that has led us to where we are today. So personally, I started my career in finance, so worked in investment banking and private equity, as did my co-founder. We both worked at Deutsche Bank together. And then in 2021, late 2021, we were kind of looking at what was happening in the crypto space with sort of these financial primitives starting to take form and, the basis of DeFi, really Uniswap and Aave being kind of those two examples of 0 to 1 moments in financial innovation. And if you think about Uniswap and Aave, these are fundamentally geared towards creating products around liquid tokens, which are most similar to liquid stocks or currencies, things that trade every day. And so you had, AMMs and you had borrowing and lending. And what our backgrounds were in was more on the illiquid side of things. So think, creating structured credit products, structured equity products, private markets, things that don't trade as frequently. And we thought there would be kind of a natural progression of crypto taking over this, vertical of traditional finance, which is a very large business on Wall Street. And so we wanted to kind of, get ahead of that and start to build what we thought would be the next innovation in DeFi. And that was really kind of in this structured credit for illiquid asset type category. And so we started this company. It was originally called MetaStreet. We rebranded recently to USDAI, but basically creating structured credit products for illiquid asset pairs. And the problem that we experienced over the last couple of years, delivering these sort of financial primitives was finding the right collateral pairs to map with, this pool of capital on chain. Because if you think about the RWA space historically, there's been tremendous adverse selection problems, where you have to ask yourself if, for example, someone's trying to do real estate on chain, why would they not go and get financing from a bank where you have sort of the most robust debt capital market in the world for any asset type is like real estate debt. And so what we realized was maybe one of the most interesting verticals of asset types that don't get, great financing, but have cash flows and can be tokenized is actually within sort of this compute as a commodity market, and more specifically, the hardware that's running these assets. And so when you think about, the variety of AI blockchains, AI marketplaces that have come up in the crypto space, where people can run GPUs and make cash flows on chain from running those GPUs, whether that's renting out to, other startups or doing decentralized training or inference, or running, subnets on BitTensor, all these different categories, right? These are all cash flowing assets, and yet you couldn't conceivably go to a bank and get, a loan against your GPUs for running, BitTensor miners, even though fundamentally you're generating cash flows just like any other business. And so we felt like there was a natural kind of spot to put the structured credit product that we had built historically and pair it with this, now semi-crypto native, semi-fungible collateral in GPUs. And, what we've seen over kind of the last 2 years is traditional credit markets have started to, get into this space as well. But they're really financing only the biggest operators. So you have, funds like Blackstone obviously doing the large deal with CoreWeave before they IPO'd. And one of the most interesting things about that is what it proved to the market was that GPUs can be, a proven collateral type at scale, and that the yields are quite high. So Blackstone did that deal at, SOFR plus 11, which is basically a 15% cost of capital. And what we thought was really interesting there is if you can, take a 15% yield profile, mid-teens, let's say, 15 to 25, something like this, on average, and pass that through to on-chain users, now you have a really interesting product from a DeFi perspective, because you have high yields that are non-inflationary and not, tied to the rest of crypto volatility, right? Your GPU's ability to repay your loan has no bearing on whether Bitcoin is up or down or sideways or whatever. And so it felt like a natural fit for us, given kind of the history we had had, understanding of these types of products, and then where we really feel like this market is going, which is, many orders of magnitude larger than it even is today, even though, the kind of GPU as a service, GPU CapEx business is already many, many billions of dollars, if not, approaching a trillion. So that was kind of a bit of a long-winded answer, but it's important to help visualize the path for us of starting with these sort of structured credit primitives, not having the right collateral to match with that, and then over the last kind of year and a half, realizing what might be the perfect collateral type is GPUs, and then rolling that into this broader kind of product where you can just access these yields as a kind of minter of a token.